Thank you, everyone. Good afternoon. Thank you for joining us our webinar today, where we will be talking about common transfer pricing risk for Malaysian business models. So we're very excited because this is the first webinar of 2022. Nevertheless, it's not the last one. We have a lot of content that we are very excited to be covering over 2022 that we hope everyone finds insightful. So before deeping dive into the topic for today, let me just do a brief introduction for those of you who are new to our webinars. So essentially, the methodology will be going into the detail and what we want to cover today, which we will give an agenda. There is a Q&A panel or button where people can place questions, as we try to allow for the last 10 to 15 minutes to be fully focused on questions and answering any or listening to any views that people may have. But before we start, let me just give you a brief overview about our firm. Our firm is Transfer Pricing Solutions Malaysia. We specialize in assisting multinational companies on managing their transfer pricing risk and advise them to make sure that they stay in compliance and out of trouble with tax authorities in Malaysia, Singapore, Australia, and Asia. We are 3 offices that cater to our Asia region. Our head office, Australia, that caters to Australian multinational groups. Our office in Singapore that assists with Singapore and Asia clients, and our office in Malaysia that assists mainly Malaysian taxpayers. We're very proud to be contributing on a regular basis to industry magazines and journals, such as the Institute of Chartered Accountancy of Singapore. And we're also very proud of being recognized by several awards, one of them being Best Newcomer in Malaysia. Let me introduce the 2 panelists for today. So first one, and who is one of our regular speakers, is Hon Chuan Tan, who is the director and the technical lead in Malaysia. He has over 10 years of experience in transfer pricing advisory. One of the things that he loves is to build up transfer pricing practices. Before joining Transfer Pricing Solutions, he built one of the practices of one of the mid-tier firms in Malaysia. Now we're lucky enough to have grabbed him for over the past 4 years. And myself, which I can see some familiar names here. My name is Adriana Calderon. I'm the co-founder of Transfer Pricing Solutions Asia and Malaysia, with 15 years of experience advising multinational companies in the area of international tax and transfer pricing in 4 different countries. As some of you may know, one of the things that we love in our firm is to actually share with everyone knowledge and tips on transfer pricing, so they have enough tips and tools to manage their transfer pricing issues, and obviously we're always available to help. So our agenda for today will be basically covering 3 aspects. One is coming back to some basics on what is the transfer pricing problem and why is it relevant for Malaysian taxpayers. Then we will be going through some common business structures in Malaysia, and in this section I will be putting Hon Chuan Tan on the spot with several questions, so he gives us our view on how to manage some key transactions and key aspects of these common business structures. And we will finalize with our top transfer pricing risk and triggers to be aware of, so you can cover yourself and be ready in the event of a review or an audit. Before we get into the detail, it would be great to hear from the audience today, what are their views on the following question. Why can TP be a problem for taxpayers? And let me just release the pool or the poll, so everyone, the poll, so everyone can participate. And the options are, why can TP be a problem for taxpayers? Option number 1, impacts intragroup contracts. Option number 2, impacts the company operations. Option number 3 is impacts the company management accounts. The following one is impact the audit financial statements. Following impacts the tax declared by taxpayers, and all of the above. So we have already 20% of participants. You guys are being very fast and we appreciate that. Let's give another 30 seconds for people to participate, and then we can release the results. Okay, we're reaching the 70% ceiling. Not long to reach. We need one more person to reach the 70%. Okay. So, 73. Okay, now we can release the results. So what are your bets, Hon-chan? What do you think is the majority of the answers?
They'd be like, I don't know, all of the above.
Okay, fair enough.
Yeah.
And you have actually guessed it correctly. So 62% of people believe that it impacts all of the above areas, with the following being split between impact intra-group contracts, and the last one is impact the tax declared by taxpayers. I'm just sharing, I'm guessing now everyone is seeing the results. So I guess the reason why we're asking this question is because transfer pricing can be a complex area, because it impacts a lot of aspects of a company. Tax being one of them, as 24% has actually guessed it. But interestingly enough, only 10% mention about the company operations, but actually, apart from transfer pricing impacting tax, it also can impact the way in which a group conducts business, because the outcome can determine the flow of transactions and supply chain that you may adopt within the business. That's why I always say that to understand TP, you have to really understand a lot of discipline: tax, finance, and businesses itself, which is what it makes it quite complex. So with that, let's just deep dive into the first topic, which is basically the transfer pricing problem. And here I would pass it to you, Hon-chan. And I guess what it would be interesting to give insights is why is it that transfer pricing is relevant for any multinational group? What are your views on this?
Thanks, Adriana. Hi, guys. I guess we thought of starting the year to refresh transfer pricing, go through what exactly have we actually come up to transfer pricing? Why is it a problem? And to refresh and then go through the common structures that we place in Malaysia. So I guess the very first question for us and yourself is what the TP tax problem is, right? As you're aware, transfer pricing only arises when you have transactions with your regular party transactions. Hence, we are here. And due to the lack of awareness and based on our experience, taxpayers in Malaysia tend to think that they could do anything they want because we are all in the same group, right? What I can do anything I want with the pricing, since everyone is in the group. So a lot of taxpayers think that money in, money out, right? So why do we have any issues with that? That is where the fundamental problems lie, right? That's where such control in place would have led to underpayment of taxes, right? Be it knowingly or unknowingly, right? I know a lot of taxpayers that they they actually have no idea that they are actually underpaying taxes. Now, how are taxes underpaid under TP? There are a lot of arrangements that could lead to that, but the main or most common setting is the setting of non-market pricing in your control transactions, which have inflated the price for the seller in the lower jurisdiction, while for the purchaser in the higher tax jurisdiction, then so that your overall taxpayer payable will end up lower, right? So you sell more than, but you have higher expenses for the purchaser in the higher tax jurisdiction, hence the lower tax payable. And obviously, some of you may ask, what about Malaysia? Malaysia has also included the domestic transaction, right? It's the same tax jurisdiction. What happens there? The reason why IRB has included domestic transactions is because of the large amount of tax incentive in Malaysia. I think there's the joke going around saying that Malaysia can be a tax haven, though the rate doesn't suggest otherwise. But it's because of the amount of tax incentives that they have, be it manufacturing, IT development, research and development, right? Green technology, right? We have a lot of tax incentive in place where a lot of companies have actually benefited from it. On top of that, it's also to tackle the loss-making companies, where especially now that COVID has risen, I'm sure there are a lot more loss-making companies than the past, where it will become increasingly important for transfer pricing, right? Unless, of course, if you are able to prove that your effective tax rate for the group, or at least for the companies that were transacting within each other, are the same, then you do not need to worry about transfer pricing, right? As I mentioned earlier, most of the time, the underpayment of the tax is actually due to the lack of awareness, which is why we're here to share knowledge of what's TP, how do you recognize TP, do you have any issues with TP, and then this will also lead to then how the IRB would enforce the transfer pricing compliance in Malaysia, right? Which is the next slide.
Yeah, thank you, Mitran. Let me just move to the other slide.
Okay.
So, yeah, you go.
Yeah, I was going to say, with as you guys have known, with increased tax leakages and COVID expenses by the Malaysian government, obviously the IRB would want to have an additional channel in place to recruit back these expenses. And I'm sure you guys have known the recent development on the additional penalties for the failure to furnish transfer pricing documentation, which is actually pretty hefty, which range from 20,000 to 100,000. And it affects a lot of the small business companies, which actually comprise a huge sum of Malaysian businesses. Hence, I guess that's the reason why they have introduced that particular penalty in place. So in the past, TP may not specifically be in a general tax audit, but now when you have a tax audit, transfer pricing would be part of the audit, right? Once you have the tax audit, one of the questions would be, could you provide us your transfer pricing documentation, right? So that's a given. So if last time we are thinking of, oh, do you have a TP audit? Now, once you have a tax audit, then automatically you'll be not directly involved in TP yet until they have looked at your TP documentation, but you would already have involvement in TP already, right? So the next thing would be to know what's the triggering point for IRB to actually target you. Obviously, unless you are large multinationals, then the level of target and you have higher risks. But generally, it actually comes from tax returns and audit financials, which are actually publicly available to the IRB, right? The low-hanging fruits are the ones that says no to the preparation of TP documentation, your Form C, right? But at the same time, you have related party transaction disclosures in your financial statements. So one point you say you have no TP. documentation, at one point you said you have 3 FIA transactions. With the penalties in place, that doesn't help at all, right? You're basically telling IRB to come and fine you, right? Because now you have, regardless in the TP rules and regulations, regardless of whether you're small or huge, you will need to prepare TP documentation. Just that the level of TP documentation to be prepared will be different, but you will still have to prepare, right? And obviously, you want to avoid falsely declaring your tax return in the first place, which could expose you to penalties and tax adjustments if there's a mispricing of transactions. So first part will be your 20 to 100,000, and the second part will be your tax adjustments. And notwithstanding that, the audit process itself is lengthy and stressful to taxpayers. And I'm sure Andrea and I have gone through quite a lot of audits, and it's actually quite stressful for us as well, let alone the taxpayer. And we think that it's an actual waste of resources.
Yeah, that's a good point. And I think another thing to keep in mind is that not only in Malaysia, but in most countries, the tax audit don't happen as soon as you lodge the tax return. This is a common question that I get. The tax authority has a particular number of years to come back and request or audit. In the context of Malaysia is 7 years. So you can expect at the moment that IRB can come and ask for questions up to 7 years prior to 2022. So that's something to keep in mind, that common practice is not that you get the audit straight away as soon as you lodge a tax return, which is why it's so important to have some history on the transaction. So when the time comes to explain to the tax authority, there is some basis for whatever it was agreed in a particular transaction. So with that, maybe we just move into the common structures in Malaysia. And before we start looking at each of the 3 examples that we have for today, it's good to spend 2 minutes talking about the common way in which multinational conduct business and how they can impact the level of profit that is left in a particular country. So with that, maybe I just pass it on to you, Hon Chuan, to explain a little bit on this aspect.
Basically, there's 2 models, centralized and decentralized. First up, centralized, that's the traditional model in Malaysia I experienced previously, where you have a primary entity making strategic decisions within the value chain from your R&D, manufacturing of goods, sales and marketing, logistics, and distribution of goods. We call this central company the entrepreneur within the group. And the benefit of this model is, the effectiveness and efficiency in terms of costs, because you're only going through one central company to make all decisions for others, and so that everything is in line with the vision and mission of the group itself, right? But with economies evolving to a more digitalized economy, the model has slowly evolved or changed to a more decentralized model, right? As you can see in the diagram, the decentralized model has more than one entrepreneur in place, making the decisions within the value chain, right? This happens generally to software companies, software services, software as a service, where intangibles and IPs are created through respective channels of development within each entrepreneur. Each entrepreneur will have their own set of processes in place, their own set of intangibles, hence they would have their own set of IPs that they could exploit from and be remunerated from it, right? So, and the next thing that we're going to talk about is more.
Can I just make a comment here? So the reason why this is important from transfer pricing is also because basically in the past, when we were under centralized model, it was understood that this was the general way in which we will apply transfer pricing, and is that the entrepreneurial or residual profit was given to one entrepreneur, which was the central company, and the rest of the entities could be remunerated depending on what they were performing on routine profit. But with newer economies, and we will talk about this in the following webinar, which is OECD and Pillar 2, we have a more tricky situation where we have two entrepreneurs that are taking the entrepreneurial risks within the group, that are developing IP. And then the biggest question is, who is entitled to what when we have different companies within the multinational group building IP and arguably being entitled to residual profits. So that's why we end up now, which we will talk in the following webinar about Pillar 1 and 2 and how it impacts Malaysia, because we end up now in a kind of a war, I don't know if it's war the right word, but a battle for which profits are left in different countries. Yeah, exactly. Battle of profits. The question is also, is it also going to be battle of losses if the business is not doing well? But that's
no one wants that.
Story. Yeah. But how does this affect any functional characterization and profit allocation?
Yeah. I mean, if you look at the illustration here, regardless of the models, in terms of transfer pricing, it illustrates the correlation between profit allocation and functions and risks, right? The more functions and risk profile you are, the higher the remuneration that is to be expected, right? As Adrian has mentioned earlier, if you look at this illustration for the centralized model, it's easier to allocate the profits because you have a central entrepreneur. But the complication arises when you have a decentralized model where you have two entrepreneurs or more than one entrepreneur, and you are effectively trying to allocate those profits appropriately to the respective entrepreneurs, depending on the functions they perform, the risk that they assumed. And having other than that, you have to also look at the intangibles that are put in place, with hard to value intangibles as one of the topics to be discussed. That also put in place how tough or how difficult it is to actually appropriately allocate profits to these so-called entrepreneurs.
Yeah, that's basically the challenges that we're facing at the moment, which we will talk profit allocation in one of our following webinars. But before we go then now into the particular structures that we're going to discuss and elaborate on, it will be great to understand from the audience, so we can spend more time in one case or the other. What category does your company fall under? Is your company an entrepreneur, an IP holder? Is it a shared service, a manufacturer, a distributor of physical products, or a software reseller? I'm gonna launch the second poll now, so everyone can spend just 1 minute giving us some feedback, and we can also discuss or spend more time in a particular structure. We're at 62, 1 minute. We can give it 5 seconds more. What is your bet, Panchan?
Services.
Okay.
Or manufacturer.
Okay, let me end the poll. You're right in the sense that a manufacturer is 30%, which actually we will cover, and is the first part that we're going to cover. we have distribution of physical products 17, which we are also going to discuss, and also other services. Interesting is other. I'm just wondering what that other is, because it's 30%.
Oh, okay.
So I'm
Maybe
just
IT. Oh,
oh
maybe
maybe
services.
yeah maybe. So
Maybe
for
not
those,
software stuff.
yeah, for those that are in other services spaces, some of the commentary that we're going to discuss will be applicable. So let's start first talking about manufacturing and manufacturing structures. And maybe before we go into the case study, we can talk broadly, how does transfer pricing approach a manufacturing structure? Manchon.
Yeah. Yeah, for manufacturing, I was going to say that Malaysia is home to manufacturers. Previously, I'm not sure about now. I'm not sure about how the government is reacting to foreign investment coming in. So it has a lot of manufacturing tax incentive in place, right? So hence, there are a lot of manufacturers in Malaysia. If you look at the pyramid style diagram, at the bottom with the bigger portion of the pyramid is the full-fledged manufacturer, right? So where we're talking about the manufacturer that undertakes all the entrepreneurial and operational activities, right? It goes from research, R&D of the products, leading to the manufacturing of the actual products, quality control, system marketing, then sales of the products, then obviously after sales. So everything under the sun, the fully fledged manufacturer will be responsible for, right? And the difference then to the second portion, which is the contract manufacturing, where generally speaking, the manufacturer will be manufacturing under a contract, and they do not have any entrepreneurial role in place. When they work on a specific customers, the customers would have specified the products, would have provided the production technology, the maintaining the QA QC, and control the manufacturing schedules. Right. Generally speaking, or most of the time, the contract manufacturer should receive less return than fully fledged manufacturer within the same market. And lastly, of course, we have the toll manufacturer, where this manufacturer is merely providing manufacturing services, where they bear the lowest risks, and they do not own the raw materials or the processes or the finished goods inventory in place. So they should by right be remunerated on a fixed margin, so to speak.
Okay. Thank you, Huanchan. So let's see this example. And now I'm really going to put you on the spot here. So let's assume that we have a Singapore head office that has set up a full subsidiary Malaysian manufacturer, and that Malaysian manufacturer sells to a related party distributor in Japan and to a third-party customer in Malaysia. So this is a typical structure that we may have in the context of manufacturing structures in Malaysia. So the first question that I have to you, given that you already told us the theory and it's all great and nice, but what is the impact, and what type of manufacturer, why the type of manufacturer is a TP challenge?
Yeah, so I guess it depends on the arrangement that your group wants the manufacturer to be in. For example, obviously, based on my experience, generally contract manufacturer is generally the type of manufacturers in place. If you look at the structures there, contract manufacturers in the middle as the middle person, where they deal with the Singapore headquarters on a contract basis, and then they sell it to, and then they prepare and provide the manufacturing services, and then sell the goods to the party and related party, right? If you have a fully fledged, for example, you have to go through your R&D, you have strategic management in place in your manufacturer to decide on what's the product to be developed, what sales marketing strategies that we are going to go and obtain and source for customers, and you'll be liable to warranties of products that you sold. So basically, and obviously the end one is the toll manufacturer, where the Singapore headquarters would have provided you all the plant, the raw materials, the process know-hows, and everything, except that you are providing services itself and then sell it to the party customers and related parties as well.
Yeah. So how is it relevant, the arrangement of raw materials, and the option being, okay, should I consider that my Singapore HQ sources my raw materials, or should I source it myself, and how can that impact my TP arrangement?
Yeah, as we mentioned earlier, the type of manufacturer would have determined the raw materials intake from your end. So if fully fledged manufacturers would have sourced, they will have their own department sourcing for raw materials themselves, and then taking title of that respective raw materials. And contract, for example, contract and toll would have gotten help or services provided by Singapore, for example, that would source the raw materials from another supplier and then sell it to and then provide it to the contract or toll manufacturers in place. So depending on whether the manufacturer takes title, I think the key difference is the taking title of the raw materials, and obviously the sourcing, the effort and the functions performed to source that particular raw materials. All this put in place into your characterization of your manufacturers, the type of manufacturers you are.
Mm. And I guess it is also a commercial decision, because it depends, for example, as well, if this Malaysian manufacturer can source itself the raw materials in Malaysia, because there is suppliers in Malaysia, versus having to source outside of Malaysia, and whether it makes sense to do it from Singapore HQ or not. That is more than a tax aspect, is a commercial aspect. Yeah. And then another question, which is probably, we brought it here because it's one of the most common questions that I get. I think we share that also for you, Hong-Chan, which is, should my transfer price be the same as the price that I offer to my third-party customer in Malaysia? So by transfer price, meaning I am a Malaysian manufacturer who sells to a related party in Japan, and also sells to a third party in Malaysia. And let's assume this is the transfer price and this is the non-transfer price, because this is a third party customer. So is the expectation that the price here and here in both transactions is the same? And what are your views?
For those that have read the Malaysian Transfer Pricing Guidelines, I'm sure you have seen the examples that are provided by the RRP as to the methods used, and one of them being the comparable and controlled price method, where it's a similar scenario where Malaysian manufacturers sell it to party versus to related party, where the arm's length pricing means that both pricing would be the same. Obviously, we have to take into account the comparability, right? So based on the e-tax guideline, the pricing should be the same to be arm's length, right? But I think the caveat here is that what the manufacturer performed for the third-party customers versus to the related party distributor in Japan has to be comparable, meaning they perform the same functions. They also assume the same risks in selling those products to both parties. Having said that, in reality, it may not be the case, right? And if you look at this example, the Malaysian manufacturer may perform additional functions to sell products to third-party customers instead of as compared to, let's say, you sell to related party. One of the examples is marketing, for example. You don't go and market and sell back to your related party, do you? Right? You don't do your best and then make market to say that, oh, I'm selling this product A and it's an awesome product, right? As compared to, let's say, you sell it to a third party, you would have performed that marketing expenses, you have incurred marketing expenses, actually sell to third party, against that to sell to the related party. And then this is one of the examples or one of the factors in place that we could, substantiate the arm's length nature that you sell to the related party, right? So we can't just look at it as an example from TP guidance. We have to look at the background information, the fact patterns between the flow of the products from for example, Singapore HQ to Malaysian manufacturer, what functions perform for both parties, and then down to the bottom line, what the appropriate sale price should be for the respective customers.
Yeah, that's why I love this question, because this is the first question that in any audit the tax authority asks is, do you sell the same products to a third party? And if you do, can you please provide us evidence of that price versus the related price? And this is one of the most challenging aspects that needs to be explained, because in practice, it may not be the same, because as you were saying, the value chain contribution varies from selling to this related party or the Singapore HQ versus third party. And if the supply chain contribution varies, then I have to split my margin between more parties. So I have to, in very plain layman terms, I have to split the pizza before more people, or among more people. So this is something to watch out for, because when answering to a tax authority, you really have to elaborate well the answer to that question. So moving on to funding the operations and loans. What are your thoughts on this? So if I was a HQ who is setting up a Malaysian manufacturer, what are the considerations when it comes to loans and funding?
Yeah, obviously funding can come from both debt and equity, right? But previously it was easier than now, where the introduction of earnings stripping rules has put in place, which has sort of complicated the situation, where you then have to look at the portion or the ratio between debt versus equity, and making sure that you fall under the criteria, or rather you don't go all out of the earnings stripping rules, where you would have tax leakages, you would have your deductibility of the interest expense denied. So you have to look through the earnings stripping rules and make sure that you're actually within the safe harbor ruling, and then not go past that. If not, then there will be tax leakages and other tax matters that would have impacted even the performance itself.
Yeah. So in a nutshell, because of the earnings stripping rules, generally, if you are setting up an investment in Malaysia, you have to be prepared to put part of equity and part debt, but it cannot be like, for example, in Singapore, where we don't have limitation on funding. So you can really set up a structure in Singapore with fully debt and not equity. A different story is whether the debt is an arm's length or not. But yep. I guess that's where it's different for Malaysia, where you have to be prepared with a certain amount of equity because of the earnings stripping rules and the limitations on interest expenses, or being willing to lose the interest expense deduction on that loan. And last but not least is another very critical topic, which is when it's appropriate to do true-ups or throwdowns. And just to give some context to the attendees, true-up and throwdown is a mechanism in transfer pricing to adjust the estimated price or the actual results to the estimated transfer price. So sometimes we can have in the contract that in this case, this is a contract manufacturer, and the contract manufacturer is going to be remunerated on a cost plus markup. But because it's so difficult sometimes to manage fixed cost, this needs to be monitored through the year and before year end to make sure that I comply the obligations of the contract manufacturing price. So the question is, what do I do to make sure that I do comply with that transfer pricing? And how do I deal with the true ups and true downs function?
Yes, Adrian, as I explained earlier, it's more about, actually adjustments to TP, right? So if resources permits, it should be monitored as frequently as possible, at least monthly, to look at your actual price versus what you have planned, your forecasted pricing, and making sure that it is in line, and then you perform it through up or through down, right? So, but having said that, you can do it quarterly, but you need to do it before closing of the books, so make sure that what in substance, because you have already done the hard work and investment to come up with an analysis with a arm's length margin to be earned, and you have to make sure that this is actually applied in your financials as well. So you need to make sure that before closing the books, you do either two up or two down, whatever it may be.
Thank you, Hontran. So with that, let's move to distribution structures. And if you can explain in 2 minutes the different the structures or aspects that you will have from a transfer pricing point of view. So how do we see it from a transfer pricing point of view when it comes to distribution?
Yeah, actually the characterization is quite similar, except maybe agent commission. The bottom part, free-fledged distributor, call it marketer and distributor as well, where they perform all the functions within a distribution department, where you have your sales function, distribution function, logistics, all the risks that we have incurred, reflecting the work of an independent distribution firm within the industry. And you would hold the strategic and operational marketing responsibilities to make sure that you sell the product. And then obviously you would, as compared to the others, the risks that you assume would be the highest, right? And then the second one would be limited risks. What's limited risks? The functions, it's similar to an agent, but the limited risks distributor would have taken title to the goods that they sell. So which means the goods are actually captured in your financial statements. And you may have agreements between your distributor to another entity, for example, a manufacturer or a principal, right? So the difference between a limited risk versus a marketer is that the functions performed will be much less if you look at how it works, and then also the risk as well. And then lastly, commission agent, as you guys know, they don't take title. The sole responsibility is to actually sell the product. Think of them as agents, sales representative. They would have very little operational functions, that they will have no strategic activities at all. They will not be involved in any of that, and they are only selling it by earning a commission percentage based on what they've sold.
Thanks, Hontran. So if we put this in practice, let's go through this example where we have a Singapore HQ that source from third-party products located in Australia. It sells some products to a Malaysian distributor who also sources some products from a third party located in Indonesia, and Malaysia sells to third-party customers in Malaysia. So coming back to your structure of the different type of products, how is that relevant? What type of distributor it is in the context of this Malaysian distributor?
Yeah, so if you look at the examples here, especially when Singapore headquarters is actually sourcing from the party from Australia, for example, then they actually sell the product to you. It depends on whether you also source from third party Indonesia, right? Then you have to look at it differently, characterization of the products that you source from the respective third parties, and then decide on the respective functions that the Malaysian distributor has performed. right? What products has the local Malaysian distributor has market and sell, and what risks that assume in terms of taking title to the product itself, and whether they have sourced the product itself or whether they have just not take title but then sell it on behalf of a particular entity. For example, here Singapore headquarter, where headquarter actually take title of the raw materials or finished goods, then sell it to the distributor. But then the distributor is only responsible of selling the product to a third party or a related party customers and earn the commission from that. So depending on the arrangement that's put in place, then you may need to characterize your distributors into different categories based on the product sold. So depending on the circumstances that is put in place.
Yeah. So that maybe lies very well with the second question, which is similar to manufacturer, but in a different way. So would the tax authority in Malaysia expect that this price, which is the price at which I source from my third party supplier, is the same that the price that I source from my Singapore HQ?
Yeah, so similarly, it will depend on the functions performed. So if we look at this example, the Malaysian distributor actually sourced directly from the third party in Indonesia. If you look at this context, I'll assume that the Malaysian distributor is one that's performing the procurement functions and sourcing the third party suppliers themselves. And then versus the one that they purchase products from the Singapore headquarters, which was sourced from a third party Australia. Then in this case, you already imagine that the functions performed for each product are different. The risks assumed by the Malaysian distributor for each product is different, right? Which means that the pricing should not be the same unless you have done an analysis and the pricing miraculously comes to the same pricing. But based on the arrangement here, right, the pricing, especially when you buy from the headquarter, should generally be lower than those that you sourced from Indonesia third party. So it depends on the circumstances.
Yeah. And I think another aspect here is if you come to, there is an opportunity here also to centralize the procurement function. Because if you want to counteract the risk of the tax authority telling you, okay, what is this price and what is this price, then there is also an opportunity to find and centralize everything through Singapore HQ. So you're dealing first with one source of products, 2, streamline your supply chain, and 3, being easier to manage the product or the procurement price from only one source, which is your related party. And there could be some optimization advantages there. And how about the concept of funding and loan? Do you see it differently that from the manufacturing, or similar in order to the limitation on interest deduction?
It will be similar, be it debt or equity. And I think we will need to emphasize again on the mixed agreements, because that is very similar to the thin capitalization rule in Australia, where they actually the sole purpose is to actually cap your interest expenses deductibility from interrelated parties, right? So we really need to emphasize that you need to look at this, because if you don't perform your due diligence analysis, then very high chance that you get it denied.
And one aspect that we haven't touched, and we will also cover in the following, in the last case study, which is management fees paid to Singapore HQ. Is there basis for this? Is this a challenge, and why is this a transfer pricing challenge?
Yeah, obviously we cover this in a greater context in our ongoing intra-group services webinars, but management fees are, I think, very common nowadays. I think the word, as Adrian has known, management for me, the word management fee is a bit too generalized, because you need to look at what has been performed by the Singapore headquarters. Why are we deeming it as management fees? And what has Singapore performed to benefit the Malaysian distributor in this place? Whether the Malaysian distributor actually benefits from the services provided by Singapore in either generating revenue or increased productivity or whatnot, that would have benefited the Malaysian distributor. And then, the appropriate charges from the Singapore headquarters, right? The actual cost base and markup to be put in place.
And similar to the manufacturing, how about the true ups and true downs? And I want to put a spin on here, and is, do you find it relevant, the true ups and true downs treatment, when you're doing physical goods versus distribution of non-digital goods?
Yeah.
Sorry, non-physical,
speaking,
digital.
Non-physical,
Yeah.
digital, non-physical goods.
Yeah.
The true up and true down process is similar. Just that I think that the complication arises is when you distribute physical goods, and then we need to be mindful of the other matters, custom duties, other tax matters that is put in place for physical goods, as opposed to a digitalized product where you can actually true up and true down without any, as of now, no implications to software-based or digital-based goods for now, unless they have, I think maybe sooner or later they may put something in place for digital goods to be similar to the physical goods.
Yeah,
Something
which
like
we will talk about that actually in one of our webinars that we're going to talk about specifically digital economies and software as a service as well. So last but not less important is services. So if you could give us just a brief overview on services, and then we will go to a case study.
Yeah. Services are broadly based, categorized into two lots. Though it can, a lot of people call it management services with both combined. But for low value added services, as the name suggests, it's low value added, meaning you have your administration services, support services. These services are generally services that could support the business operations, but not in the sense of value generating for the business operations, right? So generally they will receive a lower markup, and most countries would have a safe harbor ruling in place for low value added services, for example, Singapore and Australia, with 5%. Unfortunately for Malaysia, we do not have that in place yet. I think we have been tabulating this to get the IRB to have like all these safe harbor rulings in place, so that it actually ease the burden of the taxpayers, so that you don't need to prepare the benchmarking to substantiate your services, your low value added services. Even that value added services, which I'll talk to you later, would have that safe harbor as well. But yeah, IRB should have this in place so that it would ease the taxpayers' burden in first preparing a TB documentation, secondly, the economic analysis on this services markup. And next one is value added services. So value added services are services that would provide value, right? To, like, for example, your marketing services, right? Those are directly services that are directly helping to generate revenue for the business operations, right? You have your engineering services, technical services. These services are the ones that are value added and should therefore have a higher markup to be put in place, right? Similarly, I think technical services for Australia, they have a safe harbor ruling in place, which is 10% markup if you satisfy all the criteria, obviously. But yeah, so these are the two services that we do.
So let's see the typical services structure here. So we have a Singapore HQ, and we have a Malaysian service provider that may provide some shared services to related parties and to HQ. And coming back to your point of low value and high value or value add how is that relevant, and why is it the type of service relevant from a TP challenge? I think you mentioned kind of already on the markup side, but
Yeah.
I leave it on to you.
Okay, so I think a lot of you would have known the term management services. Oh, I've got this management fee charged. I've got this management services. But to you, what is management? What does that entail, right? And a lot of times that we have encountered is that taxpayers have included both together, right? Which is not the correct approach, right? So you would have low value added services and value added services. So the main thing is to actually look at it separately. So you would have to broadly characterize them into low value added, and then another one into low value added, right? So for example, like here, shared services provided by Malaysian services, that would be most likely be a low value added services as compared to like the corporate services, also depending on what services are entails. But if it's more on strategic management, we call it strategic management instead of management alone. Strategic management means providing strategic decisions towards the Malaysian entity to make sure that the processes are in line with the vision and mission of the group, and all the strategic decisions to be made to generate that revenue. Those are the type of services put in place. I'll then go towards the cost base as well and the markup. So
Yeah.
I understand I've gone through the markup, but I think a lot of taxpayers focus on the markup itself. Oh, what the benchmarking? What's the arm's length markup rate? But I think that's the wrong way to focus. I think you need to focus on the cost base first, because the cost base would have been the majority of the fees charged, right? So the cost base, which we'll explain in detail in our other webinars, where you look at whether it's chargeable or non-chargeable, and you look at what type of services are non-chargeable. For example, your shareholding services, your duplicative services, then you have your on-call services, unless you have specified in the contract, then maybe you can actually charge it. And then lastly, with your passive benefit services, those are services that are non-chargeable, right? So any cost incurred in those type of services should not be in cost base. And then you have to look at whether the cost itself, is it directly or indirectly attributable to the specific entity, right? Once you have had this cost base in place, then you need to also look at the markup, right? So your arm's length markup, your safe harbor ruling, and then come with a arm's length markup. And then on top of that, you also need to look at whether services are provided to, is it just one company, or is it to different companies? Is it directly attributable to one entity alone, or is it provided to more than 1, 2, 3, 4? Where then from there you need to look at how to allocate the cost appropriately, using different allocation keys, right? Different services would have different allocation keys in place, so that needs to be analyzed as well.
Yeah, that's a good point. And then the last 2 points before we close up, would you see the true ups and true downs differently, the process of true ups and true downs?
I think it'll be similar again, but I think we'll also emphasize that when you do a true up or true down, strategically speaking, true up would not have been a problem because you're truing up, and you true down, then that may be that there are some things that may arise, right? So we'll need to be mindful of doing true ups and true downs.
And what about corporate services from Singapore HQ?
Yeah.
In this scenario, would you think is an issue, or can it be a challenge?
I think in additional to the stuff as mentioned earlier regarding services provided, whether it benefits the Malaysian entity, and then obviously whether it's arm's length or not, you also need to be mindful of the impact to your profit before tax locally, to make sure that if indeed your PBT is actually loss making, then you need to analyze all these services received and make sure that all these management fees, corporate services are arm's length and properly documented into your TP documentation, so that when IRB comes in, they won't straight away say, oh, you have management fees received. I think that's one of the concerns that may have impacted your bottom line, therefore making you loss making. So maybe we have to adjust you upwards so that you're actually profit making.
Thank you, Hon-Chun. So before we pass it on to questions, because we're running a little bit out of time, but that's okay, it's not too much. Give us your 4 key tips and takeaways from this webinar and these cases.
Yeah, I think my key takeaway would be, if you go through all the structures, make sure as you can see the illustration, proper function analysis, value chain analysis should be prepared. Make sure that you're correctly characterizing yourself, and then only set up a correct transfer price. Make sure that you're correctly characterizing it, because the Director General can re-characterize you, and then that will be another problem then you don't want to face. So make sure that you characterize the function and risk accurately. And then next thing is proper segmentation. So proper segmentation, as I mentioned earlier, is more like the product segmentation, making sure that you have your real party product versus third party, making sure that the function performed, expenses incurred are correctly tabulated, and then all the transfer pricing are correctly documented as well. And third one is intercompany payments. Oh yeah, so basically, as I mentioned lastly, which is the impact to your PBT, your profitability, making sure that the payment itself, if it indeed has impacted, how bad it has impacted, and making sure that you have properly substantiated in your TP documentation that these are arm's length and they have no impact to the profitability, right? And then lastly, agreements. Yes, I think fourth one is something that's been overlooked. I think especially in Malaysia, developed countries has caught up to this agreements, where agreements is very important to be formalized, and making sure that all the transactions are documented into the agreements and then signed, and then the price are agreed between both related parties. And I'm sure Adriana would agree that nowadays agreements are very crucial in transfer pricing.
Yeah, definitely. The one document that, apart from all the things that tax authorities ask, is the one thing that is always asking audit to please provide the agreements in place covering the transaction. So with that, we can pass it on to questions. There is a couple of them. So first question is from Indonesia. Hello, thank you for attending our webinar from Indonesia. When the company is in a loss condition and is not a startup company, is it okay to use comparative data for companies that have lost? So can you use
loss-making comparables?
Exactly.
Yeah. Okay. I think this is one of the questions that we have seen and also used. I think especially now with the COVID situation, these things has changed, right? I think maybe because in the past we generally do not use loss-making companies due to various reasons on companies should be profitable. But having said that, with the ever-changing financial environment, COVID impact, it is actually okay. But then as long as we have gone through the comparability analysis and making sure that the actual companies are actually comparable and within the same industry, same functions and risks, then we can actually use those and obviously justify why we can use those, which I think the tax authorities around the world would agree as well, as long as you have proper judgment.
There is some countries that have exceptions, Singapore being one of them, which is not something that I empathize a lot with it, which is that in the Singapore e-tax guide, it says that taxpayers should exclude average loss making, which is one of the very few countries who have codified this, which in my view is technically wrong because it's trying to overstate ranges. Thankfully, in Malaysia, we don't have that very strict view. And I think the key, even with some of the audits that we had, obviously the tax authority starting point is to try to reject the loss-making comparables. But if you have very strong arguments to say it is not included because it's a loss-making comparable, is because it's really a comparable, then you have to really show the objective process to reach to that outcome to convince the tax authority on that point. There is another very good question, which I really is one of my favorite questions. Let's see if you share the same sentiment.
Maybe you can answer that too.
Company A is a contract manufacturer and company B is a full-fledged distributor. Both companies are related. Company B buys the goods solely from company A, and company A has no other customers. For TP purposes, company A adopts cost plus method to price its transfer price with company B. Under such a scenario, can tax authority reject the cost plus method and apply TNMM on the ground that company B is a full-fledged distributor?
Right,
any views?
Um,
So my initial view is that if company A is a contract manufacturer and you are just using cost plus and your only customer is your related party, I think there is a very high chance that the tax authority will try to apply the net cost plus TNMM, because the net cost plus, it is what measures the level of profit. And if you're just routine having one customer, which is your related party, and it happens to be that on top of everything, your company B is in Singapore or in Hong Kong, then there is a very high chance that they will try to look at the TNMM. What is your view?
Obviously, that would be the case. I think tax authorities around the world would they like using TNM because of the net level, because that's where they get their income from, right? So that's where they want to use as much TNM as possible. I think in that scenario, I think there are a lot of things that you can put in place, because if you use TNM, you still have to look at, TNM, one of the things is you have to choose the least complex entity, right? If you compare a full-fledged distributor versus a contract manufacturer, maybe you can argue again, but you may, if you indeed need to use TNM, then you still need to choose the least complex entity. But if they argue, then I'm sure they will want you to show the TNM as well, if you have the figures in place.
That's a really good point, because it can be a challenge of tested party as well, right? Like, why are you choosing the distributor and not the manufacturer?
Yeah, we can play around that.
Yeah. And there is a last one, which I'm not entirely sure, but you see if you understand. What are the documentations update to be known by our finance department? I'm not sure what documentations are we referring to. Are we referring about the e-tax guide or the company documentation? If you could elaborate more, we can come back to it in 1 minute. But given that we're reaching already at 3:10, let me just go with a few final comments. So we have a YouTube channel. We love transfer pricing so much that we also do YouTube videos. So please like us and subscribe. There is a lot of very good material there for anyone who is enthusiastic about transfer pricing. We have a lot of upcoming webinars, 8th of March, 24th of March, where we are going to talk about OECD and some of the Pillar 1 and 2 impact and the new OECD guidance. We have a few others on the 16th of March and 21 of April upcoming. So keep following our social media channels, where we're always informing about our upcoming webinars. And if you need any help, or if you want to reach us, feel free to contact us in the following details. Following us on social media, we are in LinkedIn, YouTube, Facebook, Twitter, Instagram as well. We love Instagram as well, so feel free to follow us. There is one more clarification. Refer to previous question. How can company B prepared TPD for supply from company A. This is coming back to the contract manufacturer and distributor. I think coming back to your point, the proper way to document is by probably selecting company B as the tested party, which is the contract manufacturer. And if it's for Malaysia purposes, then that's probably in theory the correct approach. What do you think?
Yeah, I guess you guys need to know that transfer pricing is both ways, right? Actually, if there's only one transaction between two entities, by right, both entities can prepare the same TP documentation, just as long as that transaction is the same, and then the analysis is the same, right? So we can use it for both sides for that particular transaction. And use company B as the party based on the example there.
Okay. All right. So with that, we can close our webinar for today. Hon Chuan, thank you so much for your insights. I hope I didn't put you too much on the spot.
No, that's
and we hope to see you everyone soon in our next webinar. Thank you.
Thanks.